Hello class, this is Dr. Fenton. In Chapter 11 we talk about the statement of cash flows. Now through the first part of the course we talked about the income statement, the statement of stockholders' equity, and the balance sheet. And those statements were prepared using the accrual basis of accounting. And as you remember, the accrual basis of accounting will record revenues and expenses and not necessarily follow the exact cash flow for those items. So this statement, this fourth statement that's required to be presented in an annual report, is to convert those accrual basis numbers to cash flow numbers. There are three areas in the cash flow statement, and the first one is the operating activity area. This will show cash receipts and cash payments for transactions related to revenues and expenses. The second one is the investing activity area. This relates to the purchase and sale of long-term assets and some current investments. The third section is the financing activity section. This shows the cash inflows and outflows resulting from the external financing of a business. This relates to selling common stock, to borrowing money long-term debt, to paying some of that money off of long-term debt, and for paying dividends. Let's look at these areas in more detail. Here is a cash flow statement, and we're going to use the rest of the slides to show how this is prepared. The first section is the cash flow from operating activities section. This starts with net income and then shows a variety of increases and decreases that we'll explain in more detail in just a few minutes. The second section is cash flow from investing activities. Here you can see we have purchase of investments, sale of land, and other items can go in here, and again we'll discuss this in more detail. The third section is the financing activity section, and you can see that this relates to selling stock, paying dividends, and also borrowing money in long-term debt. So we have the three main areas: the operating activity area, investing activities, and financing activities. Then we see here that we'll net the results of those three areas together. In this case it's a positive 14. We will add cash at the beginning of the period, and that will give us cash at the end of the period. Then we have another item down here called a non-cash activity that we'll discuss in a few minutes. So this is the overall cash flow statement, and we will spend the next several slides talking about this in much more detail. Now in the first area, operating activity section, this relates to cash coming in the door from the sale of goods or services, collection of interest and dividends, cash outflow when we buy inventory, when we pay for operating expenses, when we pay for interest, and for income taxes. The second section, investing activities, when we purchase investments, when we purchase long-term assets like equipment, buildings, and so forth, we loan money, or when we sell investments, sell the assets, or collect those notes. The third area, issuance of bonds payable or notes payable. Issuance of stock, that's cash coming in the door, cash going out the door, we pay for the bonds or notes payable, acquire treasury stock, or pay dividends. The income statement is used to gather data we need for the cash flow statement as well as the balance sheet and other information. So from the income statement we can determine revenues and expenses, net income, a lot of other items that we need for the cash flow statement. The balance sheet, we have to go through all the current assets, current liabilities. We'll look for changes in stockholders' equity and so forth. And the last one, detailed accounting records. Sometimes we need information that's not included in one of these statements that we'll need to show in the cash flow statement. Now you can see that income statement information goes into the operating section as well as the change in current assets and current liabilities. In the next section, we look for changes in long-term assets. Again, these would be like buying and selling of land, building, equipment, and other long-term investments. Changes in long-term liabilities and changes in common stock and retained earnings will end up going in the financing section of the cash flow statement. There is a sort of a fourth category that is non-cash activities. Here we need to show these at the very bottom of the cash flow statement, since these do not themselves, these we need to show at the very bottom of the cash flow statement. Since themselves, they do not reflect cash flow either in or out the door. So these are not cash flow items, but they are significant enough that we need to show them in the statement someplace. Examples would be purchase of long-term investments by issuing debt, purchase of long-term assets by issuing stock, conversion of bonds payable into common stock, or exchange of long-term assets. Notice none of these involve cash flow. If they do, they will go in one of the sections, cash operating activities, investing, or financing. But since these do not change or do not use up cash or collect cash, then they do not go in the other three sections, and they will go as one of the last items, as really the last item in the cash flow statement. There are generally two methods to prepare the cash flow statement. We are going to use the indirect method. Why? Because it's simple. It begins with net income. We adjust it with several items, but it is the most popular method used. It's easier, less costly. So this will be the one you'll probably see if you look at a set of financial statements in an annual report. The direct method, let's don't worry about it. We're not going to even look at it in these slides, and you will not be tested over the direct method. The only difference between the indirect and direct method is how you prepare the operating section of the cash flow statement. It does not influence investing activities or financing activities. Those are the same between the two methods. But we will use the indirect method for our preparation of the cash flow statement. All right, here's a net income statement. You can see the revenue up there, $1,012,000, a list of expenses. We also see in here, I need to point out, depreciation expense and loss on sale of land. Those will pop up in just a minute. We have to handle those separately. And then net income we're going to use from the income statement. In the balance sheet, we will need to find the difference in the current assets. And the non-cash current assets, we will need to show these separately in the operating section of the cash flow statement. We'll see that in just a few minutes. But remember, we're going to account for the differences over here in the non-cash current assets. In the operating section, we will account for the difference in all the current liabilities, though. Other information, for our example, we're going to go through. We purchased stock in another corporation, so this is a long-term investment. We sold land that originally cost $10,000 for only $6,000. So we had a loss of $4,000 when we sold the land. Number 3, we purchased equipment, but we issued a note payable. No cash was exchanged, so this will be a non-cash item. Number 4, we issued more stock and collected $5,000 cash. And then number 5, we declared and paid a cash dividend of $12,000. So let's start putting this all together in a cash flow statement. So to begin with, in the operating section, always start with net income. So go straight to the income statement and pick up the bottom line number that you see and drop it in. So start with net income. Then we need to adjust for that. Okay, so the others in here, don't worry about these items just yet. We're working towards these numbers. So we're going to look at this section right now in detail. So start with net income. Then the first step after that, after you start with net income, is to go through your current assets and your current liabilities and account for those changes in the operating section of the cash flow statement. So we look for depreciation expense. If we have that, we look for non-operating items. These will be gains and or losses on the sale of long-term assets. Then we look for those changes I've already mentioned in the current assets. This will be non-cash current assets and current liabilities. Here's a little chart that you could memorize. This would help. What we're going to do is, once we place net income in the cash flow statement, we will always add depreciation expense. So whatever it is in the income statement, drop it in here, add it to net income. And if you happen to have amortization expense, add that also. We're not going to have it in our examples. What we're doing is, since depreciation is a non-cash expense, remember, The entry for depreciation is an adjusting entry, and we debit depreciation expense and credit accumulated depreciation. No cash was involved with that entry, but it was an expense. We did use the depreciation expense to lower net income, and so what we do now then to convert net income to a cash flow number, we add depreciation expense back to net income. If we have a loss on sale of investments, we add the loss back. If we have a gain, we subtract the gain. A loss, we'll talk about this more when we get to the investing section, but a loss is not really negative cash flow, and the gain on sale is not really the net cash coming in the door. Okay. But just memorize this for now. If you have a loss in the income statement from the sale of other assets, add the loss. If you have a gain, subtract the gain. Any increase you have in a current asset account that is non-cash, so we're talking about accounts receivable, inventory, prepaid items, subtract an increase. If we have a decrease in those non-cash current asset accounts, add the decrease. The pattern for current liabilities is just opposite. If we have an increase in a current liability account, add it, and a decrease, we subtract it. Now these increases and decreases I'm talking about are from the beginning of the year to the end of the year. Did the balance in those non-current asset accounts increase or decrease? I'm not talking about the actual increase or decrease that happens on a daily basis. I'm just talking about the beginning numbers, the beginning of the year compared to the end of the year numbers in these current asset and current liability accounts. So here's where we're starting the top of the cash flow statement. Here's net income, add back depreciation expense, add back the loss that we have. So we had a loss on sale of land, we add that also. Again, here's the pattern, the rule for changes in current assets, current liabilities. So let's go through these with the numbers. If you remember, our accounts receivable balance decreased from the beginning to the end of the year $7,000. Since that account increased, that means there's that much more cash we did not have compared to the revenue that were recognized for that sale. So in other words, the rule is if we have an increase in the accounts receivable account from the beginning of the year to the end of the year balance, we subtract that increase. Decrease in inventory. Inventory went down. The rule says if we have a non-cash current asset account that decreases in its balance, we add the decrease. Prepaid rent. It increased during the year. We subtract that to follow the same rule we've been using for the current asset changes. Accounts payable went down. The rule here, if that accounts payable account decreases from the beginning to the end of the year, then we subtract the decrease. If we have interest payable, it increased, we add the increase. And that was it. We've had gone through all the current, the non-cash current assets and all the current liability accounts. We have finished that section. We'll come back to the statement in just a minute. Now let's talk about the investing activity area. We're looking for items such as property, plant, equipment, and other intangible assets. Did we buy some of these? Did we sell some of these during the year? In our example, we purchased investments of another company for $35,000 cash. So purchase of investments, we used cash. So cash decreased because we purchased this investment. Yes, it's good the investment went up. We've used some of our excess cash to buy into another company. So now we own part of another company. But you're looking here and you're showing what happened to cash. And cash went out the door to make this investment. So we show the decrease of $35,000. Number 2 shows we sold land that cost us $10,000 in the past. We sold it for only $6,000 cash. Well, we received $6,000 cash. So cash comes in the door. Yes, we had a loss of $4,000, but here you're showing what happened to cash. So cash came in the door, $6,000. And then here we purchased equipment by issuing a note payable. And number 3, no cash was exchanged. So this will show as a non-cash activity at the very bottom of the cash flow statement. financing activities. We're looking for cash transactions dealing with the company's creditors, debt, or stockholders. If we sold more shares of common stock and received cash, that's an inflow. If we paid a cash dividend, that's an outflow. So positive $5,000 in cash and then a negative $12,000 cash. So the net result here is $7,000. Now, most investing activities can be explained by changes in long-term asset accounts, and most financing activities can be explained by changes in long-term liability accounts and stockholders' equity accounts. Put it all together. These are the numbers we've gone through. We saw this at the very beginning of this video slide. So again, net income you start with, add depreciation expense, add a loss on sale of land. If you had a gain on sale of land, you subtract it, but we had a loss here. Go through your non-current, your non-cash current assets. We have 3. Show those changes. Go through go through all of your current liabilities. Show those changes. Make sure you follow those rules we saw earlier. And so if we have a decrease in a current asset account, we add the decrease. If we have a decrease in a current liability account, we subtract the decrease. Net all these together, they net to $50,000. So this shows us from our day-to-day operations, this company generated a positive $50,000 in cash. You really want this number to be positive. Now, it might be negative, especially for startup companies, but sooner or later, this number right here must be positive, or the company, through its operations, is not even financing itself. So if this is a negative number and continues year after year to be a negative number, you're going to go bankrupt. You've got to have the company finance itself through its operations. That's what this section is showing you. To me, this is the most important number in this statement, and is probably one of the most important numbers in all 4 of the financial statements. This shows what's happened in the investing section. We talked about this. Purchased investments, sold land, nets to 29. Financing, we issued stock, we paid dividends. We didn't in this case, but we could have borrowed money in bonds. We could have paid long-term principal off. That would be reflected here. We have 2 items. They net to a negative 7. And now the $14,000 is the net of each of these 3 areas. So it's very important to keep these numbers as positive or negative. Positive 50, subtract 29, subtract 7, we get $14,000. So this whole statement up here is showing that our cash balance changed by increasing $14,000 from the beginning to the end of the year. We need to prove that now. And the way we prove it is go back to the beginning of the year balance sheet. Pick up the cash balance at the beginning of the year, add it to our increase, and then this $62,000 must equal the cash balance we have in the balance sheet at the end of the period. So you're tying this whole statement into the cash account. If this statement is showing cash went up $14,000, then you must be able to add this to your beginning cash number to get your ending cash number. Now, if the net decrease here was negative, you would take your beginning cash amount and subtract the net overall decrease in cash to get your ending cash. But right in here, this is tying all this and proving that the numbers you've worked with up here are accurate, because this positive $14,000 you just generated, when added to the beginning cash balance, does equal the ending cash balance that we have. This last item, the non-cash activity, here's where we purchased equipment and with no money down, signed a note, issued a note, and we owe for it, yes, but $20,000. It was a major transaction that needs to be shown somewhere. But since it's not dealing with cash here, we don't put it in the investing section here. A lot of people try to, but no, this is a non-cash activity. We explain what it is and show the dollar amount down here. So that's the full statement. That's the full statement. It is quite detailed. It will take you several times to go through it. So again, go back and review these slides and follow the example through. work through the quizzes several times if you need to before the exam comes up. Now there are some ratios you can generate to sort of analyze how a company is generating cash and so forth. This is what I said earlier. Your positive cash flow from operations, and that's your operating activity area, that's very important for a company's long-run survival. If that cash flow, net cash flow from operating activities is negative and stays negative year after year, you're not going to stay in business. You're just not going to have the cash to stay in business. A couple of companies you're familiar with, Apple and Google, and I'm sure these numbers came from a previous annual report for each of these. And these numbers are in millions of dollars, so if you wanted the actual number, you would add 3 zeros out to each of these. Excuse me, you'd add 6 zeros out to the end of each of these. Let's take these numbers and generate some ratios. Return on assets. This might sound familiar. We covered it before. You'll take net income for the company, divide by its average total assets. So beginning of the year plus end of the year assets divided by 2. So it looks like Apple's generating 18% on the assets it has invested in the business. Google, 11.9%. Here's a new one for us in this chapter though. Cash return for assets. We take the operating cash flows for Apple, divide by the same average total assets, 27.2%. Let's compare that to Google. It generates $22 billion, if you add the 6 zeros, in operating cash flows, divided by average assets, 18.5%. So you can see Apple is doing a better job in using its assets to generate operating cash flows. 27% compared to 18%. Cash flow to sales for Apple and Google. Divide operating cash flows to the sales it had. So for Google, it's 22 divided by 66, 33.9. So it's doing a little bit better than Apple in generating cash flow from sales. But this just lets you evaluate companies and how well they are generating operating cash flows compared to the amount of sales that they have. Well, that's the end of Chapter 11. Again, a brand new statement for us. This takes information from the income statement, the equity statement, and the balance sheet we prepared earlier, and turns those accrual basis numbers into cash flow numbers. To me, cash flow is extremely important in the business. And if I had one statement to really look at and evaluate a company, I personally would go with the cash flow statement. You need to keep up with your cash flow. If you have a small business, you're worried about cash flow for making payroll, to paying your suppliers, to paying your taxes and so forth. So cash flow is very important. So this statement, it's the fourth of those required statements to be in annual reports. But it is, to me, one of the most, if not the most important statement. So anyway, again, review the slides here. Read the chapter, reread the chapter, and follow the examples through in the chapter. So good luck with your studies.